All right, we're back. AWM Insights is here. It's a shortened holiday week, so we're recording this on Thursday, April 17th. Markets are closed tomorrow for Good Friday. And I don't know if it's because it was a shortened week or, I don't know, everyone just needed a little bit of a breather, but it seems like this week, it doesn't seem like it. Markets did behave somewhat. I say that word somewhat tongue-in-cheek, if you will, because yesterday actually was a pretty big down day. I don't think we would call a week with a 2% plus negative day a quiet week per se, or in normal times, but given the volatility we've been experiencing, it's been a little bit of a reprieve. So maybe we just start there. Just give us a quick refresher, Mena, on what happened, or even update for those that weren't paying it close attention, which you should. That should be most of you, hopefully. What happened in the markets this week? What was the cause of that drawdown?
Yeah, so we started the week having a little bit of a recovery from all of the craziness with tariffs and changing valuations. And on Wednesday, it sort of was a thunderstorm, but a thunderstorm feels like nothing after a hurricane. We had some information from the Federal Reserve, just testimony from Jerome Powell on tariffs, the impact on the economy, the impact potentially on inflation, how it could be negative, how prices might move away from where the Fed actually wants to lead them. And then on NVIDIA's front, they are just factoring in the cost of the tariffs. There was around a $5.5 billion adjustment that they highlighted. So we're already starting to see the potential impact of tariffs on prices and on company earnings and just total revenue.
Yeah, and probably a lot more to come on that front. So
Definitely.
we're still relatively early on the impact of these tariffs making their way through the system, making their way through company financials. You know, maybe it will all be cleaned up by the time a lot of them report, but we'll see. We certainly saw that there was an impact to NVIDIA, like you said. One thing we wanted to talk about, given the slight reprieve in the day-to-day chaos, really, there's probably not a better word to call it, that's been going on within the markets over the last 2-3 weeks now, maybe even 4. We wanted to zoom out a little bit and talk about year to date. And you know, we'll start this conversation with the preface that, hey, don't look at short-term returns, but there's been some interesting just reminders of the fundamentals around investing. And you know, I'm kind of leading the question I'm going to ask you here, but some great reminders around diversification, why we stay diversified, et cetera. So it'd be great to kind of go through some of these, the data points, what's gone on in the markets, where markets were to begin the year, where we are now, and the great lessons that we can always remind ourselves from this period.
Yeah, it's definitely been a rocky year. And I think through times of stress, what we see is a return to fundamentals, as you were highlighting, where a few points that I'm going to make, but you just return to the core principles and core tenets of financing and of finance and investing. So since Liberation Day and the subsequent reversal, we saw a pretty substantial outperformance still in international and emerging market positions. That is to say that international diversification, even though a lot of people have been down on it since U.S. markets have done and domestic markets have done so well, there is a place for it, and international diversification is powerful. It's a powerful way of reducing risk and also capturing return during times like this. On the other hand, valuations matter. So especially what we've been seeing and what we've seen this week, with the NASDAQ being down yesterday, Wednesday, 3.1%. On the other side, you saw the Dow and the Russell 2000, which represents smaller companies typically at better valuations. Those were down 1.7 and 1.1% respectively. So you are seeing more negative impacts hit companies with more stretched valuations and investors rotating into companies that are valued more attractively. And that's really the fundamental component is valuations matter. During times of stress, investors will care more about valuations, and especially during times of stress and uncertainty in domestic markets, investors will take opportunities globally and internationally.
Yeah. There's a great quote. I say it a lot. In the short term, markets are voting machines. In the long term, they're weighing machines. One of the challenges, you don't know when they're going to change from a voting machine to a weighing machine. Certainly in times of stress, they generally do. And that's where the fundamentals really come into play. Rewind to the end of 2024, the general narrative was American exceptionalism is going to continue. We're going to have a new wave of M&A activity or a substantial pickup in M&A activity and IPOs. And, fast forward to today, I don't think anyone would have guessed we would be in the position we are in presently. So not only is it a great testament to some of these foundational aspects around diversification and portfolio management, but just a reminder that predicting the future is incredibly difficult, incredibly difficult. Going to wrap with some news that happened today, but again, just kind of trying to extract these examples from the present day and extrapolate them to some of these core tenets. So today, specifically, UnitedHealthcare came out with earnings and they were terrible. I think is a fair way to say it. And there was a really interesting market reaction. So why don't you walk us through that, Mena?
Yeah. UnitedHealthcare reported bad earnings and also negative forward guidance, which is just forward earnings projections based on an increase in the cost of care and general inflation that is just impacting their costs on the front end. So one of the interesting things is if you go and look at how analysts on Wall Street and at some of the biggest institutions actually valued UnitedHealthcare, they valued it as if it was trading at a discount. And today, immediately at the start of trading, it started trading 20% below what it closed at yesterday. So trading at a discount, but still got absolutely hammered on price. And that pulled the entire Dow Jones Industrial Index down. So that's one small company. The interesting thing is the Dow Jones represents 30 industrial companies. They're price weighted. So they're weighted based on how much a cost of each share is. UnitedHealthcare, I believe, was trading at $550. So it represented around 11% of the index. It was the most concentrated position in the index. When that happens, when you get a massive down day from the largest position, obviously the index is going to pull back. And that's exactly what we've seen. And really, it's a testament of not taking individual stock risk and not trading stocks based on what, analysts tell you, what potentially your friends in finance might tell you. Diversification really is fundamental. It's a key pillar, going back to fundamentals. You need it to ride out these waves and not get burned by situations like this that are just bound to happen in markets.
Yeah, 100%. Awesome little summary there. Hopefully these little nuggets were just helpful reminders. And again, just tying back our philosophy to actual data. That's what we're doing here on this podcast, bringing the present day news to our portfolios and how we think about that. So hopefully it's helpful. Hopefully these reminders give you a little bit more context to the why, the philosophy behind how we're constructing portfolios, how we're managing money, and overall just beneficial to you. So we'll wrap there. Again, shortened week, not necessarily a shorter podcast as a result. It just looked at the time, but we're all good. Hopefully you enjoyed this one. And as always, own your wealth, make an impact, and always be a pro.